We're doing a special episode today of Rational Investing, and I'm very happy to have Ayesha on the podcast on the YouTube channel to go through her macro advisor's presentation of China. She's been doing a lot of deep diving into the macroeconomic forecast for China, and it's a big topic for us. We've looked at Alibaba and JD.com, so let's figure out what's going on in China. And please welcome our very special guest. Ayesha to the channel.
Well, thank you, Cameron. Thank you for having me. As I was saying just before we started, I'm a big fan of your YouTube channel. I've been watching you for the last couple of years.
That's very
And
sweet of you. Thank you.
seriously, it's my favorite channel because I love the way you present and break down stocks and you do the work. And that's what we're all about. So, and as I was saying, sometimes putting in that extra effort really matters. So for me, I've always found that to be a very important step, whatever you're doing.
Well, I appreciate that.
So
Thank you very much. I see you on Twitter. I really like the content you're posting. We'll get into it later, but I saw a tweet that you discussed where you're breaking down the amount of revenue that U.S. companies derive from China, and I think it's a really interesting risk for some of the U.S. stocks as they're trading at all-time highs. Exactly how much revenue they're pulling from that country.
that's right. So I think what we'll do is we'll go through some of the, intermediate to short-term issues that we're facing here, and then some of the more secular issues in and around China, and why we still remain a little cautious from an investing perspective. But before we begin, so shall I just share my slide deck here?
Yeah, share your slide deck and let's give me a little background on yourself and how you got into this, and we'll kind of go from there.
So let's dive into the macro analysis of China.
Absolutely.
So what we'll cover today is a little bit about us, my background, and then what's changed in China. There's the short-term view. There are some, changes coming through. And then we look at, the structural challenges that still
Mhm.
persist. We look at the stock market and a few stocks, and then finally some takeaways. We'll also cover what you just talked about, in terms of US stocks being influenced by China. So just to give you a little bit of a background, Macrovisor, which is the company, was founded by me and my partner in 2023. So a very new company. We're just about a year and 2 months old. What we do is global macro research, and then we look at the macro research and figure out cross-asset class strategies. So it could be, investing in countries, commodities, stocks, markets, different kinds of things. We're very proud to say that we've been featured on Bloomberg, on the regional Ashard Business, and on Fox Business as well.
Fantastic.
Thank you. So my background is basically, I was a former corporate banker. I have about 20 years of experience. Well, it's going to be 20 years this month. I started out with Standard Chartered as a corporate banker. What I did was I covered local companies, so not listed companies, mostly private companies and large companies, homegrown. I started in Bangladesh, that's where I'm from, and then I moved to the UAE about 17 years ago with Standard Chartered. We also did cover some government accounts, so that was pretty interesting. And then I left banking and I became the CIO for a large family group where we handled assets of over $1 billion. The assets were split between real estate, hospitality, and listed equities. So that's where I got my flavor of listed equities. And anyway, as a banker, as a corporate banker, you're not really allowed to trade. It's very difficult to trade because you
Yeah.
have a lot of insider
Index only.
information. Yeah. So basically, I didn't touch the stock market
Yeah.
all those years. But then, when I moved as a CIO and I was managing my boss's portfolio, he had about 300 million odd in listed equities.
Hmm.
So I started dabbling as well. And so that's where my listed equities exposure started.
Nice.
But of course, I've been reading balance sheets for, let's say, 20 years now.
Yeah, yeah, yeah,
So,
yeah. It's funny how you get distracted by work, right? It pulls you away from doing your own research. I had the same issue. I worked for 20 years in corporate finance, running businesses as a CFO, and you're just so distracted. You don't think about, doing your own work. And then time moves on. You're like, well, wait, maybe I should take some of the skill sets and, apply to my own fortune. So I totally understand what you're saying.
I promise you, I wish I had started investing much, much earlier. I mean, it's something I missed out on. But better late than never, right?
Absolutely.
So, and then I really enjoyed that job as the CIO. It was great. I learned a lot. But then I thought it was time for me to start my own thing.
Mhm.
I always wanted to own my own business. So I started in 2019 with a consulting company doing, corporate finance consulting, raising debt and
Mhm.
equity. It was okay, but 2019 was a tough year. I don't want to say I failed, but I did fail a little bit.
We had
Okay.
2020 with the shutdown, so all deals stopped at 2020. I mean, I remember when that happened and just the entire world paused. So anything that you thought was going to close, you're kind of banking on it. You put all the work to get the books together, make the market, and then it just absolutely craters. I completely understand.
Exactly. It was a crazy time. But I did get lucky because what I did is I went back to work with some of my ex-bosses on the syndications desk. So what we
Mhm.
did was we bought and sold loans in the secondary market. So that was very interesting as well. And then, I got onto Twitter, met a few people. I saw people were writing these newsletters and they were
Mhm.
doing, putting out content. And it all seemed very interesting to me. And I realized, you know what, we can actually spin up a business around this. I mean, we
Mhm.
have all this research. And most people, retail individuals, don't get the kind of information
Oh,
that you and I provide, right? The big boys, they gate their information and their research, and it's
mhm.
very expensive. So it's wonderful to see people like you, people like me, spin up businesses at affordable prices for everyone,
Yeah,
you
that's
know?
right. Yeah, that's exactly
Uh,
why I did it. I worked at IPOs. I worked with Goldman Sachs, and we would underwrite IPOs, and I would watch the forecast be developed, and a lot of the assumptions in there were just wildly optimistic because everybody wants to get paid in this IPO. And I thought, well, why don't we do it a little differently? So now when I on my channel when I publish works, we go through all the assumptions that are in there, and people can make their own assessment of those assessments reasonable or not, but they know where it comes from.
Absolutely. And this is why I like your channel so much because, you go through each and every step. And I think the banker in me really appreciates how you lay it all out.
Well, thank you. Let's dive into China.
Yeah, let's look at China. So why are we talking about China now? The reason is we've been seeing a little bit of an inflection since the beginning of February. So this is the last 3 months change. So, and the major sort of ETFs that cover China and Hong Kong. So Hong Kong's still not doing very well, but the other, mainland China equities have started to inflect a little bit. And so what's going on? Um, what's changed is the cycle has bottomed. So let me just take a step back and explain why macro fits in so well with fundamentals here. So basically, when we look at the cycle, when we look at the macro cycle, what we want to see is points of inflection, right? We want to see the rate of change of macro data, and we want to see how this data is basically changing. And so when we look at the macro data for China now, what we can see is on the left, you can see the industrial production data that's sort of starting to pick up now gradually. We're nowhere close to the long run average, but we are getting there gradually, right? So we're better than where we were last year, let's say. And then this is the latest data, which encompasses the manufacturing PMI data. So the PMI data, basically, it's a survey data, but it basically shows you business activity and manufacturing activity within the country. And if it's above 50, it's in expansion. If it's below 50, it's in contraction. So that's how it works. And China produces two sets of data. One is for small businesses and export companies, and one is for large businesses. So the gray line is large businesses. The purple line is smaller businesses.
Interesting.
So what you can see is all throughout 2023, the smaller businesses have been trying, and the export businesses have been trying to inflect upwards, right? But really didn't take off until, let's say, the fourth quarter of 2023.
Hmm.
And in 2024, rather, what we're seeing is now the large cap companies are also taking off. So basically, all of this is pulling the market slightly up, right? So
As
we
it
can see
bottoms and,
expansion.
and manufacturing slowly returns. It's interesting.
Precisely, precisely, precisely. So then we look at inflation. So China, unfortunately, has been experiencing deflation, something
Hmm.
probably the US wants desperately. But throughout most of 2023, we saw very low levels of inflation or outright deflation. But that is sort of inflecting now. So the last print we got in February, it came out positive. Now, I completely realize that one print doesn't make a trend. However, what we can see here is as you start to look at the year-on-year change and the rate of change, we will see the comparisons, or what we call base effects, start to get easier, right?
Is China doing monetary printing or QE or any of those other tactics now? Or
Not yet.
so they're not doing that. This is simply industrial production. It's the real estate market kind of, bottoming out, if you
Slightly,
will. Okay.
yes, yes. It's slightly, let's say, yes, the cycle is inflecting now and we are bottoming out there. So, and you can see that in the producer prices, which is on the right side, the PPI. And this is like the wholesale manufacturing level prices. And you can see it started to gradually get better, right? So, but what we see here is the base effects will sort of remain until the end of 2024. So that's when, the comparisons continue to remain easier, and we'll probably see positive numbers until the end of 2024. And I'm insisting on 2024 because we need more for this to continue. So right now we are, benefiting from the cycle, from the inflection, but we need structural changes in China for this to be sustainable, for this growth to continue over the next 5 years, let's say. Exports are also getting better.
Do you think that growth is going to come from the retail market, or is this is mostly industrial, but the retail consumer that's been slapped by the decline in real estate, right? All of their savings is basically they were just in buying spec homes. And
Yes.
do they have the money to then go out and start buying goods and consuming like they had in the past?
So the retail consumer does have the money. The problem is the government. And I'll show you some charts. I have some great charts about this
Okay.
in a little bit. So just to show you about the exports, now, obviously, exports is big for China, right?
Absolutely.
And look at how it dropped. It dropped massively between 21 and 23. So, okay, 21 was COVID, 22, they had the lockdown. 23, we should have seen improvements. We did not, right? We saw it go even further negative. But now we're starting to see some positive signs come back. And interestingly enough, sorry, go ahead.
I'm hearing about a lot of CEOs and CFOs that are moving their sourcing away from China, and this data reflects that as it's negative. People are pulling material out of China. I'm not sure if it returns to positive growth as much as it did in the past. It might kind of level off and not be negative anymore. But going up 25% as it did historically in 2021 is probably unlikely. I mean, I don't know. What do you think?
No, you're absolutely right. So there's this whole nearshoring,
Yep.
reshoring kind of, situation all over the world, where after COVID, people were so scared about the supply chain situation, right? And with China and the major countries like across the world being locked down, all the supply chains getting stuck. Everybody's thinking we need to have multiple sources of,
Yeah. Some sort of
supply.
diversification of their supply.
Correct.
Yep.
And nearshoring as well. So in the sense that we need them to be closer. So just in case we don't have to travel across the world to
Makes
bring
sense.
things back, right? And then also there's a little bit of China as well in this. So if you see the chart on the right, basically what I'm trying to show here is that China also has stopped exporting to countries that are not so friendly anymore. So they've changed their policies as well. So it's not just the environment, it's not just the macro, but China as well is changing their own policies, which is quite surprising. But then
Absolutely.
again, not so surprising when you take into context geopolitical tensions and sanctions and
It makes
things like
sense,
that.
right? They want to create a parallel network to the SWIFT network using the renminbi as the underlying currency, and in exchange for doing that, they're going to probably trade more favorably with nations that are willing to use their system. And so it's an interesting kind of duality in the world that's slowly presenting itself.
It is. And so I don't know if you can see, but the pink line at the bottom, which is like the line that's like
Mhm.
inflecting upwards the most, those are the BRICS countries. So you can see how politics is playing a part in all of this, right?
Absolutely. Yeah, it's definitely spikes up.
So the bottom line of this is, again, until the end of 2024, I think conditions will remain conducive, in China, as we come out of that bottom of the cycle.
Hmm.
However, China has bigger problems, right? So, and we break these problems, and these are structural. These are within the country. We need them to change if we want to see this growth become sustainable.
Hmm.
And so we break this into like three parts. One is the consumer and the crisis of confidence. The second is the debt deflation spiral, which is, surrounding the businesses and local government. And then finally, the GDP growth and the shift in mindset coming out of the government. So just to quickly go over these, the consumer. So this is a chart that you sent me actually, and it's a great chart because this is the backdrop to what's happening, right? So
Yeah,
we're seeing population, first of all, their population is aging, and then secondly, it's shrinking.
it's
And when
amazing.
that happens, yeah, and when that happens, obviously, the result is lower consumption. And as we all know, consumption is what drives GDP, consumption is what drives growth in an economy. So without that consumption, you're going to see revenues come down and obviously then the bottom line as well.
Yeah, that's right. There's many countries that are facing that same problem of even the US, Japan is probably the easiest example, Europe, China, a lot of the developing countries are having population problems as either policy is affecting, like China is saying, hey, the one child policy, or just
Mm,
cost of living and people not wanting to spend that much money having two, three, four children. It's really starting to put a hamper on the population growth, which is one of the big underpinnings of GDP.
absolutely. So like in the US, there's this new concept, right? DINK, double income, no kids.
Mhm.
So more and more, I think younger people are moving towards not having children, or, I can't imagine a situation like that myself, but,
Yeah, I saw a stat. I think I don't know if Elon Musk posted it, but someone was saying that something like 40% of the women in their 30s have no children or might not have any plan to having children in the United States. It's a major issue. And to your point about debt deflation, if we have ever rising debt, right, that debt is underwritten by a kind of economic trend that's happened over the last 40 years of just constant growth over time. That trend, people tend to believe it's going to go on in the future. But if population is underpinning that and the population even flatlines, paying back that debt is going to be very, very difficult for the people who will remain in the world.
yeah, and I don't think most governments appreciate this enough,
No, no. I
honestly.
did a brief stint underwriting um, public debt. So in investment
Mm,
banking, you have private companies go raise IPOs, or you can do municipal bonds. So for the state of
that's right.
California, Department of Labor, Education, like I did some underwriting there, and a lot of the city governments, it's all tax based, mostly pinned on revenue, and they will bond all the way up to like 99% of, if not more, of the
Wow.
taxable revenue. And if there's ever any kind of movement in that tax base, they quickly go upside down. And we're seeing kind of the same thing here. If everybody is fully leveraged, assuming this 50-year trend is going to continue, and if the population stalls, we're going to have a real problem.
Yeah, definitely. So coming back to your question before, do they have the money?
Mm.
So the slide on the right, or the image on the right, shows you, yes, they do. Look at their savings. So China has one of the largest savings, stack in the world, right?
Well,
They're far above
almost
the EU.
30% of global. Wow.
Yes, they're far above the EU or the US. But the problem is they're not spending this savings. And that's where the whole issue comes. So if you look on the right, you can see household consumption has actually come down below investment. So total
Mhm.
consumption is being pulled down by household consumption. So, and all of this is because there is a crisis of confidence in China. Even though the government has sporadically given, incentives to spend, and they have the money, as you can clearly see, people don't want to spend in the country. COVID lockdowns was a big reason. Now, coming out of the COVID lockdowns, we saw the chart on the right, and we all thought that, hey, China's coming back in a big way. And I did that too, until about February, March, when I realized I was wrong and they're not coming back. And I started to dig into China even more. This is March 2023. And since then, I just went negative on China, and we got it very right for the rest of the year. But the truth is, it's a difficult call to make when you're looking at savings, at this level.
Is that
So
savings? Do you
why?
think that savings is cash, or do you think that savings includes some of the real estate that's illiquid, that maybe they're carrying a value and saying, oh, it'll come back? Like how real, I guess, is what I'm asking, is the savings number?
So it's not the real estate, but it's
Okay.
mostly liquid. So it could be
Okay.
stocks and stuff as well,
Okay.
but not hard assets, let's say.
Got it.
So why this crisis of confidence? Basically, what we have in China right now is a vicious cycle. Okay, and so if I could just explain this vicious cycle a little bit quickly. So the consumers stopped spending because of COVID lockdowns, right? So they were scared because of COVID lockdowns. So what happened is they stopped investing in the property sector. Now, the property sector therefore saw their cash flows dry up because there were no, new purchases coming through. The government also cracked down on that a little bit by saying, homes are for living, not for speculation. So there was a little bit of government intervention there as well. But what happened basically is China's property sector works on off-plan properties. So basically, they sell you the property before they actually construct the property. And this keeps going in a cycle.
Spec home.
So when the music stops, everything starts to crumble, right?
Yeah, there's no
And
cash to
because
finish the buildings that they already promised people, and they can't sell more
exactly.
buildings because they're not selling any existing ones yet.
Exactly. So there you have the consumer and the property sector situation. Now, the property sector, what they do is they buy land from the local government, right?
Mm.
Now, the local government, when they sell the land, they use this money to pay off their debt, to pay off, infrastructure spending, to pay off interest and stuff like that. But now the property sector is out of cash. So the local government is out of cash.
Yep.
So they kept on just compounding their debt. So you can see on the left, 2014, the local government debt was something around 53%. Now it's 105% of GDP. So it's ballooned, like doubled, right? In
Amazing.
about 10 years. And then who does the local government sell these bonds to? They sell it to businesses. Businesses use these as investment vehicles, just like treasury bonds, right? Because they're government at the end of the day.
Yep.
And so now the businesses are not getting the interest on these bonds. So it's all like, so it goes back to, and then so the businesses are not, hiring people. So you have unemployment, you have youth unemployment. So it's basically a serious vicious cycle here. And this is causing debt to spiral upwards and deflation to spiral upwards. And all we're in a,
Fascinating.
I want to say, in a very, very difficult situation as far as China is concerned. It's sort of like what Japan experienced 30 years ago, right? After their property sector collapsed.
It's incredibly hard to get out of. I mean, the U.S. had this in the Great Depression, right? When
Yes.
you had deflation, you had a spiral. There's a lack of confidence. People are stopping spending, which causes further price declines. It looks like China is experiencing the same way, but they're experiencing it with almost 300% debt to GDP ratio, which is an incredible amount
Yes.
of leverage that a country can put on it. I mean, the United States is, I don't know, 120, I forget
120.
the number.
Yeah.
Yeah.
Yes.
Um, and this is double that. So it's an incredible problem that they have. And I'm not sure. That's my question earlier about, are they printing money? Because aside from either just blanket defaults across the board on almost everything, or just printing money to pay the debt, I mean, I'm not sure how they're going to dig out of this hole.
That's the problem here. So the regulations in China, I mean, sometimes I wonder what they're thinking, honestly, the government, because You see, even you are hammering on this, that they should be printing money, they should be doing something, they should be cutting rates. They need to jumpstart consumer spending, which they're not doing. The other thing they're not doing is, so the local government is kind of under the federal government, but unfortunately, the federal government is not standing by the local government. So they're not guaranteeing the debt.
Interesting.
So at the end of the day, if these local government entities, or what they call LGFV, local government financing vehicles, if they go bust, it's kind of like mini government, defaults.
Yep.
And so far, they've been able to refinance the debt. They've been able to, sort of repay the debt and restructure and all the stuff that bankers do. But at the end of the day, you can see how this is ballooning,
Mm.
and it's unsustainable. The debt is
It's a real
simply as
problem, and the
it
local
is.
governments don't have the control of the currency. If the federal government of China is not going to backstop their debt, it's only the federal government that can print the money. A local state, a province has no power over the currency. And if they can't pay it back, they either, I guess, seize land to kind of take it back, or they have to go under. It's a very real problem, and maybe China will seize assets. Maybe that's how they'll boost income, just by reclaiming what the kind of the capitalist system inside China had built, and just kind of reclaim it for the purpose of the people.
But then again, what people? Because, there are abandoned cities, abandoned villages now, because,
Sure.
again, the population is shrinking, right?
Amazing.
So they've, gotten themselves into quite a pickle here. And the only thing that can change all of this is the government stepping in.
Hmm.
Unfortunately, the government is looking at something else now. So the government is seeing a shift in mindset. They don't want to be known as made in China anymore. They want to be known as made by China.
Interesting.
So what we mean by this is they want to improve their level, or let's say their standing in the world in terms of manufacturing. So all this time, whenever we got something from China, we knew they were like cheap goods, easily
Hmm.
broken. So they want to come out of that reputation, and they want to start manufacturing, fancy stuff. So their new three manufacturing initiatives include, new energy vehicles, renewable energy, and battery technology. So they want to move towards technological manufacturing.
Interesting.
In order to do this, they need to, so it's becoming a little bit more developed, let's say. And so in developed countries, what we see is, the GDP growth is not as high. So last year, China accepted a GDP growth target of 5%. This year, they've set the target at 5% yet again. Now, when we compare it, obviously, to Europe or to the US, it's much higher. But when we look at the long run average for China, which was 8.8%, this is tantamount to a recession.
Hmm.
So when you put it into context, the government is okay to accept a lower GDP growth rate in order to fulfill their visions. But at the same time, this isn't helping the country. It's not helping consumer. It's not helping the consumer. It's not helping businesses, and it's certainly not helping any of that debt, right?
Yeah, it's very difficult
So this needs to change.
if you have the U.S. and others pulling manufacturing out of China, right, bringing down GDP, population is declining, down GDP, and then China is saying, "Hey, we want to go and level up and be a value added manufacturer to the top tier." Who else is going to do the kind of the dirty, if you will, manufacturing, that they have to go outsource that to some other country so they can be the new value add manufacturer in the world for the Chinese system that they're setting up. It's an interesting long term vision. I mean, good luck to them. It's very difficult to do that if you're bumping up against 300% debt to GDP ratio.
That's the problem. So they are trading their long-term vision for short-term pain, but the short-term pain is basically building into a long-term pain. So again, another spiral, but like it's a doom spiral. It's not good at all.
All right, let's see what we got. See what happens
So
next.
Yeah, so let's look at some stocks. So as I said, we got it very wrong in the beginning of 2023, where we thought, and you can see this inflection at the end of 2022, where everybody thought China was coming back, but they didn't, obviously. So the 3-year return has been terrible
Yeah. I heard a
for
lot of people
Chinese
call
stocks.
China uninvestable.
Yes, and perhaps everything I've shared today can give you a reason why.
Yeah, it's
It
very
can
concerning.
explain. Yes, it is concerning. And when you look at, so that's the word, investable. So if you want to trade the stocks for a quick return,
Hmm.
that's probably something you can do in the short term. But from an investment point of view, I am still not convinced that it's a place for us to invest in.
Yeah, I think I agree with that. I don't know if you listen to Kyle Bass at all. He's a hedge fund
Yes.
manager in Texas that has a
Hmm.
lot of research in China, and he's been saying that the mega cap stocks, the Apples, the Starbuckses of the world, the Walmarts, are actually having a problem getting their cash, the free cash flow that they generate, out of China. That China says, hey, once it's installed here, you made it, congratulations, but I'm not going to let you transfer it out. And they're actually counting that as net investable assets when the Chinese
Wow.
report their investment, for direct foreign investment, they're counting the cash generated that's not allowed to repatriate. So, you know, a part of when we look at some of the stocks like Alibaba and JD.com, their free cash flow yields are double digits. They have tremendously strong balance sheets and a lot of free cash flow. The question is, you know, at, at what point does the stock bottom out? Does it go higher if the consumers aren't able to bring back their consumer spending? These are consumer stocks. And then if you do make profits, even trading, will the Chinese allow you to take that profit back out of the country? It's an issue.
That's, yeah, that's always an issue. And so I know people keep saying stocks are undervalued or stocks are cheap here. And you sent me this chart. It's a great chart which shows, the PE comparison, right?
Mhm.
And it shows how low it is. But at the end of the day, given all these problems, you have to wonder whether it's a value trap or not.
I
Cheap
agree.
is not always good, right?
Yeah,
And I think, sorry, I think you've covered that very well in many of your, YouTube videos, that just because something is cheap doesn't mean that it's valuable.
yeah. We try to look for that five. So we look for five key attributes, right? We want to see revenue growing, we want to see EBITDA or enterprise level earnings grow, strong free cash flow, low debt, and something that's reasonably priced, not cheap. We're not trying
Yes.
to pick up cigar butts here. This is not Warren Buffett in the 1940s or whatnot. You want something that has reasonable value. I'm
Yeah.
not sure that the Chinese stocks are going to revert to the mean. That's kind of the question.
Yes. You're absolutely right. And we're not seeing what we need to see for them to revert to the mean. Let's put it this way. So we're not seeing the kind of government support that we need for them to revert to the mean. And so this is another chart that you sent me, which is the Golden Dragon Index. And, we're well below where the the peak was for
Yeah.
this index.
For those that don't know, this is just it's a chart that tracks stocks in the U.S. that are public in the U.S. that do most of their business in China. And it's clearly there's a clear peak during COVID, which kind of was cleared out, and then it continues to slip as the Chinese economy itself continues to fall.
And so this is very interesting, right? So even though the US market is doing very well on their own,
Mhm.
their exposure to China is not doing very well, right?
That's right. Yeah, I wonder
Um,
if the U.S. stock market is getting a lot of foreign capital coming in because it does not know where to go. And even though this U.S. Um, is highly is at a top tier in its valuation in terms of you know legal regulatory laws, security, liquidity. The
yes,
United States stock market is still the best market in the world. And if you're
yes.
worried about global issues, you kind of dive into the U.S. Even though premiums multiples are high, you think, well, at least I know I can trust the legal system. It's liquid if I have to get out,
And transparent.
and transparent. Yeah, absolutely.
So the level of reporting is unparalleled, right?
That's right. And that, the one thing Kyle Bass has been very critical of is the level and granularity of data that comes out of China and how he believes that
Yes.
that data is adjusted for good faith, if you will.
Yeah, yes, and I think some of the data is manipulated, but we have to work with what we have.
True.
But even what we have doesn't look very good, unfortunately. I mean, you can see the real estate index for China. It's just like this is another reason, by the way, why GDP is going down, because property companies actually accounted for a huge portion of the GDP. So that's dragging down the GDP as well. So property investments, basically, on the investment side of the GDP
Something like 20%.
equation.
It's a big number. It's not.
It is a big number.
Yeah.
It is a
It's
big number,
that's
yes,
really really continuing to hurt the economy.
absolutely. So, and this is Baba and JD.com. Did you want to speak about this a
Yeah,
little bit?
I just wanted to show kind of the evolution of the stocks. So on the left, this left hand side here, you've got Baba on the top. It's just the stock chart, and then below it, you have kind of the percent change, and you can see it's basically flat back to 2014 pricing level, or a little less than
Mm.
that, which is incredible. Which is a decade of stock gains have been erased as a result of price decline and market multiple contraction for these, or earnings decline and market multiple contraction for these two stocks.
It's a bit crazy, yeah. Made a full
That's right.
round trip.
Yeah, complete round trip, and over a decade. And what's happening is you're seeing free cash flows spike as people are concerned about the underlying forecast for long term cash flows for the business. For Alibaba, as an example, currently 10.4% of free cash flow yield on a multi-hundred-billion-dollar enterprise company is a tremendous value, in air quotes. The question is, in the future, what does that cash flow look like? I mean, we have a forecast very simply of basically 3% long-term cash flow growth from this
Right.
level for Baba. Not knowing what's going to happen, but just saying, hey, it's going to grow 3%. If that happens, it's a 30% IRR investment from here. And
Oh
you
my.
can kind of, you know, maybe a small bit of, contrarian says, I'll put a little money in there. If it's there in 10 years, great. If it's not, it wasn't my big, it doesn't not going to bring the portfolio down. But at these levels, if you believe it's going to grow even a little bit, the return is very nice for someone willing to take the risk.
So I don't know if you saw the news today, but they reported like a huge level of buybacks done in the last quarter, and they are expecting more buybacks in the next quarter. And this is in addition to their dividends. So they are returning cash
Saw that. Yeah.
to the shareholder. Unfortunately, to me, it reeks a little bit of desperation.
Mm,
Um, and I think their strategies, and I haven't followed them very closely, but I think, some of the strategies that they've been trying to undertake in terms of their cloud and, splitting up their business. They tried to
mhm.
do an IPO of their logistics company. They didn't do the IPO. So they've been a little bit all over the place, let's say, in terms of strategy as
Yeah.
well. So just not just looking at the numbers, but if you look at the whole story as well, predictability, I think, becomes a concern.
Mm. Yeah, I agree.
And,
After Jack Ma was kicked out, and the CCP pushed in kind of state regulators to be executives in the company, and I thought that's gonna kill a lot of the you know ROI seeking investments. They prevented the Ant IPO that they wanted to do,
yes,
and I think that means you can't take the 10-year average growth rate that they had on earnings of 20% annually for a decade and say any of that is going to apply to the future, because
yeah,
the whole crew that did it is gone. Like, they're just different.
yeah, exactly. So there's it may not continue at all. And
Yeah.
so this is JD.com.
Same thing here, right? It's an amazing company, that's got 20 billion in cash on the balance sheet. Enterprise value 80 billion. So just a quarter of the enterprise value is just sitting in cash. Um, Earnings growth tremendous. Revenue has grown 33% annually for over a decade. You can't make these numbers up. They make $7.5 billion a year in free cash flow, but the stock trades like it's a penny stock and nobody wants to touch it. It's 11.5% free cash flow yield. Again, the same story here. We have slightly higher growth expectations. If we're going to guess, it's hard to guess that it's going to contract. So we always guess that it's going to go up. That's what everyone does. But if it does, you're looking at maybe 16, 17% IRR for a decade. It's got a very interesting, attractive level to beat the market. Baba's probably a bit more attractive, but you have the same underlying issues. The macro economy is kind of
Mm.
questionable. The leadership changes have been problems. And does the CCP step in and say, "Hey, we're going to run this company. Thanks for building out an amazing company." That's a big risk.
So one company that I do like though is PDD, so Pinduoduo. I don't know if you've heard of Temu. That's their newest launch, basically.
No, please.
It's a cheaper version of Amazon.
Nice.
Quite
Okay.
like, yeah, quite like Alibaba Express and stuff like that. But so you get a lot of cheap Chinese goods, but good stuff. So it's not like throwaway kind of stuff.
Mm-hmm.
Good solid stuff, but at really, really cheap prices. So they've done really well with that launch. They launched in the US, they launched all over the world, in fact. And they made it easy for the consumer to sort of purchase things off of that. So with Alibaba, I think the problem was Alibaba Express, rather. The problem was you had to buy in bulk if you wanted that kind of pricing. Temu doesn't do that. So you can buy even one piece or one item, but you'll get it for like 1/3 or 1/4 the price.
Amazing.
Personally, I've seen the ads, I've been on the website, I haven't ordered anything, so I don't know how their fulfillment works and how good their fulfillment is. But seems like people love it because you can see they've really, really taken off since the launch of that. I think it was about a year ago. So this is a quarterly bars. So I want to say much of that cash flow came, after they started Temu. So the other thing about PDD is as well, they actually like to help small businesses in China, and they also help farmers. So they're very much into the social, selling kind of thing as well. So everything considered, this is a company that I may put my money into for the
Mm-hmm.
longer run.
Mm-hmm.
They seem to have some of the better values and better strategies, and they're not growing as fast. And you can see over the last 2 years, even though Alibaba and all of these companies tanked like there was no tomorrow, Pinduoduo
They're
actually
up.
has held up quite okay.
Mm-hmm.
So the chart above, it shows you the price as well. And it's been okay. It's not as bad as you would think so. So uh, this is one
Very
company
interesting.
that I do like there.
Okay, we'll take a look at it. Thank you.
I was just gonna say maybe you can do a video about
Yeah,
it.
we'll take a look at it. Cool.
Okay. And so then this was the chart that you
Yeah.
liked.
Yeah. I like this one a lot of just who's getting what from China. And you know, for us as cash flow investors, I'd be curious, and I actually tweeted at you with this, that it'd be neat to see what this looks like on a percentage of revenue. So,
Yes,
example, the chart is saying has $68 billion of revenue coming from China. What is that relative to their entire portfolio? Finding those stocks that have a big chunk of cash sitting in China. Starbucks is one that we like. The stock's at an all-time 52-week low right now. I like the company, love it, but they've got a lot of locations in China, and China's a big expansion
they do.
plan for them. If they can't do that, then their earnings are going to suffer going forward.
Yeah, so I think Starbucks, we have Starbucks, McDonald's.
Mm-hmm.
Um, Actually, if you think Nike, if you think about it, a lot of these companies do have a sizable amount of their income. I mean, in terms of a dollar amount, so it may not exceed 2 billion, but to your point, the percentage actually
Yeah.
could be quite high in terms of overall revenue for many of the companies. And that's what starts to get a little bit more concerning here, right? Because what you said about them not being able to repatriate profits, that could actually lead to a very difficult situation for these
Yeah,
companies.
that would be very difficult. So, and if there was any kind of there's ever any kind of conflict over Taiwan between the U.S. and China, sanctioning China the way the U.S. sanctioned Russia would be extremely much more difficult, right? Can you
Yeah.
imagine in Russia, right? Major companies left, McDonald's left, and so forth, and so the Russians basically just took over the factories and started making the same product. You have the same problem could happen in China if there was a conflict. The Chinese would step in, repatriate all the manufacturing and everything that was built out, and run that infrastructure for their own economy. So I think it's definitely a concern. And I don't like where it's going. I just don't know what to do about it.
Yeah, well, it is something to think about. To your point as well, you were saying about, where the cash is going. So investors have definitely, when we look at the fund flows, international fund flows, obviously international funds flowing into the US in terms of investments have declined. Sorry, into China have declined.
Mhm.
Some of that, yes, has gone back to the US, but a lot of that, interestingly, has gone to Japan now and India.
Fascinating. Fascinating. Well, India, I think that didn't. What was the stat? Did their economy pass China? There was some stat that came across that was really surprising the other day.
Correct. So their GDP growth in the last quarter was over 7%. Um, and the country is doing really well, and they're a little bit they're in that cycle.
Hmm.
They're bottomed out, and now they're in the inflection part of the cycle, the growth part of the cycle. So they're introducing data centers, technology. A lot of the great companies in the US who built out the infrastructure for data centers are actually moving to India as well now
Fascinating.
to build out that infrastructure.
That's gonna be
So a
amazing to
company I
watch.
looked at was Sienna.
Hmm.
I don't know if you know this company. It's
I haven't done it.
CIENA. So they've started their operations in India last year. A few other, you would think IT would come from India, but a few other of these IT infrastructure companies are actually moving into India now as, the next step.
Fascinating.
So yeah, it's quite interesting. So big growth coming there. Right. So we're at the end. I just wanted to sort of recap everything for
Yep.
everyone. So in the short term, again, the cycle is inflecting. We're into growth mode a little bit. And so it might be good for stocks in the short term, possibly until Q4, but we would leave it at that, specifically because of the long run structural problems that we talked about. It's a big question mark there. What we do want to see is government stimulus, more money printing, as you said, rate cuts, monetary policy, changes to the monetary policy. They've been very stubborn about all of that.
Hmm.
It's been very piecemeal. None of it has come, as a bazooka stimulus as everyone's expecting, and that's what's required. We need the government to step up there. We need regulations to be more transparent and a little bit more sensible. So last year, there were crackdowns on, internet stocks. There were crackdowns on biotech stocks, on healthcare stocks. So
Yep.
they just wake up one morning and they decide, you know what, we're going to crack down on this sector. We're going to crack down on that sector. And you can't tell where the next hit is coming from. So regulations are a little bit all over the place. And until we get that transparency, let's say, it's going to be very difficult to invest for the long term in that country. Sure, you can take a chance. Question is, are there better places to put your money? I think they are. So there's no reason for you to put your money in a place where you're unsure versus, all the great companies you have in the rest of the world. And then, of course, we have Trump tariffs. I don't know if Trump will come back to power, but it's not like the Biden administration is very friendly towards China either.
Yep.
So everything is like getting worse in terms of tariffs and geopolitical tensions, right? So
I
at the end
agree.
of the day,
Yes.
right. So at the end of the day, while we are optimistic in the short run, we see the challenges in the long run, and we'd be careful about investing there.
Yeah, I think that's right. It's the risk reward. Yes, the reward seems like you're getting a 10% yield, but if you can't get the cash out of the business or the country, or even the country nationalizes at some point and takes your money, those are big issues. I would much rather have a steady 8, 9, 10%. Like you don't need much over the long term just to make sure you keep that principal. That's the main point. Well, Aisha, thank you so
Yeah.
much for taking the time to do this podcast and vlog with me. I really appreciate it. Thank you so much for saying yes. This has been an absolute pleasure. Where can people reach you? What are your websites? What's your Twitter handle?
So my Twitter handle is my name, Ayesha Tariq, all together, and our website is Macrovisor. So you can just go to www.macrovisor.com. That's where we have our research. It's a subscription-based model, but we have a lot of free stuff as well. We maintain a long-term portfolio as well as investing ideas from all over the world. So we look at a dashboard every week, different countries, different asset classes, and we give you our views on the short term and the long term. So we do a lot of research. I think people will find it interesting to supplement their investment journey.
Well, I certainly do. I follow you on Twitter, and I like what you're posting. Please continue, and we'll do this again sometime. We'll see how China pans out.
Thank you so much.
Take care. Bye bye.
Bye.